Welcome back. We're going to call this next chart WBI. Wonky, but important. This chart is the difference between 10-year borrowing costs here in the United States against 10-year borrowing costs in China. And as you can clearly see, well, trust us if you're on the radio, there is about a 3% gap between the same borrowing costs here and in China. It's only 1.65% on their 10-year versus 4.78% here. Okay, what does that mean? Let's talk about it with Adam Kobeissi. He is founder and editor-in-chief of the Kobeissi Letter. Always a must-follow as well on social media. You bring these cool charts, and love having you on, Adam. It's a neat stat, okay? But what does it mean? What does that tell us either about us here in the U.S. or China?
Yeah, well, first, thanks for having me. It's definitely a wild start to 2025. I think it's pretty incredible that the global economy right now is more interconnected and intertwined than it has ever been. But major economies around the globe are seeing exactly different situations and backdrops between, and you just underscored that. Look at China. That 300 basis point gap in rates is massive, one of the biggest we've ever seen. And they're actually dealing with 6 straight quarters of deflation, the exact opposite of what we're dealing with now with inflation back on the rise. They haven't had 6 straight quarters of deflation since 1999. So it's the complete opposite situation. They have stimulus now. The consumer sentiment is at record lows. And I think eventually these economies can't be siloed anymore. I think it's going to start to spread a little bit. With that said, I think a lot of people in the U.S. right now would say, yeah, I'll take lower prices. But it's also...
Well, deflation sounds nice on paper. You go to order a burger or dinner or go to the grocery store, you're like, man, I wish we had lower prices. But they come with a cost, right? Prices tend to go down because of bad things. So as much as we would like the cost of things to go down, generally, not always, but generally deflation can also be a dirty word.
Absolutely. So look back to the Great Depression, right? Actually, even in around 2008, 2009, around the financial crisis, we saw some deflation. But China is living proof right now of how catastrophic that can be. Their high yield real estate index is down over 80% from the high. There's literally ghost towns of new properties being built, and no one wants to buy these properties. Why? Because if you have $1 today and it's going to be worth more tomorrow, why spend that money today? It's the exact opposite of deflation, right? And as a result, the economy effectively comes to a halt. And even with these widespread stimulus measures being unveiled by China, they still can't escape deflation for now. So you kind of want to, you don't want to be on either end of the spectrum. You kind of want to be in the middle. It's like a pendulum, right? It swings to inflation, but then it swings back. And you don't want to swing into deflation. You kind of want to softly fall back into that Fed's 2% target, which is why obviously that's been a lot more difficult to achieve, and they're still in the process of achieving that. But that's why you don't necessarily want to see falling prices after all.
And it was interesting that Xi Jinping reportedly himself asked his leadership, what's the big deal with deflation, which tells you there's not going to be a big impetus to fix it. But Adam, I was just going to pick up on what you said about pendulum. I mean, it feels to me like everything is going to such an extreme. So now China's in more deflation. Their currency is weakening further. Our dollar is strengthening. That's going to be an even bigger headwind for manufacturing and so forth, right as Trump and team are about to take office. So everyone who talks about how we're so imbalanced, we're too much of a consumer economy, like the things happening in the market today are making all of that worse. And now they have to come in, try to make it better without upsetting the apple cart. And I mean, good luck.
Yeah, absolutely. I mean, look at the U.S. dollar index. We're now at 110. I think you guys were talking about that earlier. That's a multi-year high. I think that's a 24-month high. That makes doing business with the U.S. extremely expensive for people that are using currencies other than the U.S. dollar and having to convert their currency to dollars. But also, it's interesting because then you see assets like gold. Gold is, in U.S. dollar terms, continues to be incredibly strong, now trading around 2,700 in a market where the 10-year note yield is up 100 basis points and the U.S. dollar is up 10% in 3 months. So that's something we've also been looking at. So I think from a trader's perspective, these large moves and these big contrasts that we're seeing between major global economies actually create opportunities to trade. But it's definitely not something that the Fed is too excited about, as they now have all 3 measures of inflation back on the rise. You have 1 month, 3 month, and 6 month annualized measures of CPI, PCE, and PPI inflation actually accelerating even more, and now rising towards 4%. I think it's possible we could see rate hikes return in 2025.
A lot of our